lenders have a lot more clarity on the rules of the road for mortgage loans now because federal regulators have released what's known as the Qualified Residential Mortgage Rule. The rule requires lenders to follow certain underwriting standards to originate what are considered safe loans that they can sell 100% to investors on Wall Street. If the loans don't meet the standards, lenders have to hold back 5% of the loan amount on their books, and that makes the loans more expensive for borrowers. The rule is a victory for real estate. NER's Charlie Dawson explains why.
Definitely a win for consumers because it ensures that they'll continue to have access to safe and affordable mortgage products without overly burdensome down payment requirements.
So what the rule does is it prevents the credit market from getting worse for most borrowers. The question now is, what will the rule do to the credit market going forward? And Ken Fears of NER Research will talk about that.
Well, over the near term, we're not expecting much of an impact, and that's a good thing. Part of that is because lenders have already become accustomed to the qualified mortgage rule. They've had nearly 2 years to absorb it and to become compliant with it. Furthermore, they'll have another year before they have to comply with the qualified residential mortgage rule, but since it's equal to QM, that means they'll have 3 years essentially to have already adapted to it. However, one of the very important tenets of that is that the current market, about 85% of it is run through the GSEs or through the FHA. And they have an important exemption of the rule, and that's the back-end debt-to-income ratio of 43%. They're allowed to go over that ratio because they have very strong underwriting standards that have been time-proven. For that reason, though, in about 6 years, once the GSE's exemption to that rule expires, a larger portion of the market will be exposed to the QRM rule and risk retention, which means a larger portion of the market, in the neighborhood of 12 to 16%, will be exposed to higher costs and reduced access under risk retention.
NER's next task is to look beyond the federal rules and see what other impediments to the availability of credit for creditworthy borrowers is still in the market. Again, NER's Charlie Dawson.
For a number of years, we've been talking about credit overlays. It's important now that we have this framework to look at ways that we can reduce that so that the consumers that do qualify for credit are getting it.
To get more on this, go to realch.org and type in QRM in the search box.